Nigeria's tech space has been blazing hot with rising valuations into the millions and billions of dollars. But are they an accurate reflection or overhyped? What is the story here with these tech valuations? How do we look at them? To answer the question, we're joined by Kayode Omosebi, who is the co-founder and director, Cedar and Ash Capital Limited, to talk to us. Kayode, you're very welcome. Thanks for joining us. So we've seen a lot of in fact, let me just throw it to you. How do you assess the fundraising, the valuations that we've seen in the tech space? Is it as a result of, especially in payments, is that because of Nigeria's financial inclusion gap? How do you see it?
Yeah. So, well, I won't say it's about financial inclusion because when you compare Nigeria to other countries, I mean, we have high financial inclusion rates. The only problem is that a large part of this financial inclusion is driven by retail, by savings. So a lot of these people who are already included in the financial sector don't have access to other services like payments, like loans, insurance, pensions, investments. And then that's what the tech companies are coming to drive. So I think it's about closing the gap, even in the existing space, and then also the strategy. So, and then when you now come back into the attractive retail market, because I mean, the retail market in Nigeria is consumption driven. And I mean, if you have, for example, Lagos State, who have like 827 billion annually spent on eating outside of your house, 74 billion on rent, it shows that there's a lot of value on transactions that are ongoing there. That's what the tech companies are targeting, that the banks are not targeting, and that's where the value comes from. Because the banks today see retail most times from a liability generation just to gather the deposits. But there's more value in transactions and in assets that you can create from there. And that's what the tech companies give. The yields are high and they're more profitable. Because, for example, 2019 today, if you look at First Bank, revenues of 697 billion, you look at operating expense of about 97 billion. You look at someone like Carbon or Coda, who has like 6.3 billion revenue, and then cost of about 580. So the margins are better, and they have that tendency to grow revenues faster and they can do it at less operational cost because it's tech. And so that's why when you look at it from them, they seem more attractive than a commercial bank. And I think that's what investors are looking at.
So would you then say the valuations are justified?
Yeah, they are sometimes justified. Valuation is an art, right? And it's also perception of people and different things that they're looking at. So when you look at it from the ability to scale, to double, makes sense. But what I think is that there needs to be some caution because there are risks that apply, macro and also regulatory risk. And that's what you need to start to factor. I mean, you can't be making billions of naira on foreign exchange and not start to see yourself as a foreign exchange player. So the question is, what's now the regulatory cost of these things? And if I have discounted that from the valuation, then maybe it might not look as fantastic as this should be. But I think that the valuations still represent something, which is the body market and the opportunity for the tech players.
As far as the banks, I mean, you've mentioned them looking at things from a liability perspective, but couldn't they have solved financial inclusion by now? Is it a population infrastructure challenge that they're facing?
Well, you know, the truth is that I worry about financial inclusion because the truth is that it's not everybody in Nigeria that is bankable, profitable. You can't bank everybody.
Correct.
You have to focus on those that can be banked. The banks have done that, and I think they can scale that. But I think the problem is just paying attention to the other services they need. People like us that can bank, the question is how many of us get access to loans from the bank? But you go to some of these tech platforms and then you can get a loan. So I think it's also just being more service-oriented in terms of your banking. And you can't blame the bank. I mean, if you have cost of funds of 2%, massive billions, and you have your profits, you see most of the banks, their profit is coming from either loans to big corporates and investment income. So you're taking the large retail deposits and then you're using to create assets investment income. When you're making 100 billions in profit, do you really want to start looking at those 5-point-something billion from a tech company? So sometimes you lose focus. That's why I think the old code can make the bank start to look at things differently because they can start seeing tech from a business as against a division of the company. So, and that's why the difference is that the tech companies create digital banks. The banks are creating digital banking products. It's different because you're still running on the same operating expense, the same structure. So it affects your ability to scale and to actually serve those customers better than a tech company.
For the tech companies, or if you're investing in one, if I was to ask you your cost of capital, what would you throw up?
Well, I will put, it's tough because I can't put figures to it. Really, I'll put a lot of premiums to Nigerian banks, right? And why I'll say that is I'll discount a lot of exchange rates and regulatory concerns because there's a tendency you can scale from 1 to 100, 1 billion, 10 billion easily. when you're going in a bigger space, you start to be a player in certain areas that regulators would put their eyes on. And in Nigeria today, the capital requirement for playing in that space is high. So if I bring that, the question is, if I bring in 2 billion naira to be a microfinance bank, then keeping out 2 billion, what are the effects on my cost of capital coming into that space? So that's why I would think that it should be higher than a Nigerian bank, definitely. But then the return still will justify because of the growth that it portends.
Are we at a level where we can say there's competition between the two, the fintechs and the banks in the space that they're playing in?
Obviously, yes. And it shows like the banks are suffering from shrinking margins, and non-interest income is what they are using to see the play. And most of them are looking in that space. So yeah, there's competition because they are pursuing the same customers, really, those that are already in the financial, that are already included financially, but are needing more services or are needing more bespoke services for them. So I think the competition is there. The banks too are also faced with a lot of issues from operational cost, that they have branches. So they're already in it, right? Compared to someone who is starting greenfield and then has started all these operations based on tech. So to play in that retail space, the millennials who already understand what happens elsewhere, you would struggle with the tech companies. So that competition is there. But it doesn't stop the fact that there can be collaborations.
You've preempted my next question. Is there room for collaboration within that competition?
There is.
Yeah?
Because first of all, in my mind, when I see the tech companies raising funds, I always ask myself, why are the Nigerian banks not buying into it?
Aha.
Right.
Good question.
That's the question.
Yeah.
You can see it from separate entity. You buy into it, you support it, because the tech companies can go bigger than what it is if they have some banking support, right? So you can invest in the bank into it, but you don't bring it into your business. See it as a business of its own that can create that service. So I think those collaboration, because tech companies, when you come to settlement, when you come to some FX place you can do, the banks are still the ones strategic position for that. And the truth is that the market you're serving will grow bigger. An SME, a small business, become a medium business. If it becomes a medium business, most times you might not be able to serve them because you don't have what it takes to be a bank. So that's why I think that collaboration needs to be there when you're thinking in the future. But the bank itself needs to start investing in these companies because that's where the opportunity is.
How big of a factor is regulation in all of this?
Well, it's massive.
Yeah?
It's massive, right? It's massive. And then it's now, it's a question for the regulators. You know, there are two types of regulators. When I look at countries like Kenya and Rwanda, you realize that the regulators that support the tech, and they're more entrepreneurial regulators who are trying to allow room for you to grow. But when you have protective regulator, it's a different ballgame entirely. Protecting the banks or protecting players that are already there. It now looks like a competitive or disruptive way. You don't have to disrupt. You can improve. All right, so it's big. You need to factor it, especially when you are playing in tech space. I will put it at maybe one of the highest weights today because the market is defined already. But what can make or mar you is actually regulatory risk. So I would price it at maybe 30% of what I'm factoring in terms of discounting the value of a tech company.
Fantastic. Okay, so by the minute to go, overall, maybe I already know what your answer is. But overall, would you say tech valuations in Nigeria are overhyped or generally accurate?
No, I won't say overhyped.
Yeah.
But I'll say they're slightly overblown. Slightly,
okay.
Right? Because, like I said, I would discount some things, regulatory and all those things, and you realize that the value might not be sometimes as big as it is. But yeah, I also understand that investors invest for different reasons. Like some of them are strategic investors. And so because you're strategic and you want to push things and influence things, you might have to put some premium into the value. And sometimes what's driving the value for tech companies to is also the demand. You have 10 investors looking at a company, right? So people start to put premium on it beyond the value of the company itself.
Kayode Omosebi, co-founder and director, Shida and Ash Capital Limited. Thank you so much for joining us.